Kraft Heinz. The name alone conjures up images of iconic American brands, ketchup, macaroni and cheese, and so much more. Oscar Mayer, Jell-O. These products are staples in pantries across the nation, enjoyed by generations. Yet, behind this facade of familiarity, Kraft Heinz is grappling with a challenging reality: how to reignite growth in a fiercely competitive and evolving food industry. The company is facing significant hurdles that require innovative solutions. Despite its household name status, Kraft Heinz has been facing headwinds in recent years. The company's iconic status alone is not enough to shield it from market pressures. Revenue growth has been stagnant, and the company has struggled to adapt to changing consumer preferences. The financial outlook has been less than rosy, with stock prices reflecting these challenges. The once mighty food giant is at a crossroads, needing to find a way to revitalize its brands and regain its footing in a rapidly changing market. Strategic decisions made now will determine the company's future trajectory. The challenges facing Kraft Heinz are multifaceted. From internal restructuring to external market pressures, the company is navigating a complex landscape. Consumers are increasingly seeking healthier and more natural food options, a trend that has put pressure on companies like Kraft Heinz to reformulate their products and innovate. The demand for transparency and quality is higher than ever. The rise of smaller, nimbler competitors has also intensified competition in the food industry, making it harder for established players like Kraft Heinz to maintain market share. These startups are often more agile and in tune with current consumer trends. Kraft Heinz's struggles are not unique. They reflect broader trends in the food industry. Many large food companies are facing similar challenges as they try to stay relevant. As consumers become more health conscious and demand greater product transparency, food companies are under pressure to adapt. The shift towards healthier eating habits is reshaping the industry. The challenge for Kraft Heinz is to leverage its iconic brands and vast distribution network to regain its competitive edge. By innovating and staying true to its heritage, the company can navigate these headwinds and emerge stronger. One of the most pressing issues facing Kraft Heinz is its inability to generate consistent revenue growth. Despite being a household name, the company has struggled to keep up with the evolving market dynamics. The company has been plagued by stagnant sales, which have been a persistent issue over the past few years. This stagnation is a reflection of broader challenges in the packaged food industry, where consumer preferences are rapidly shifting. Consumers, particularly millennials and Gen Z, are increasingly drawn to fresher, healthier, and more sustainable food options. They are more conscious about what they consume and the impact it has on their health and the environment. Often they opt for smaller, independent brands perceived as more innovative and in tune with their values. These brands are seen as more authentic and transparent. This shift in consumer preferences has left traditional food giants like Kraft Heinz scrambling to adapt. The company has had to rethink its strategies and product offerings. Their reliance on processed foods, high in sodium, sugar, and artificial ingredients, has fallen out of favor with a growing health-conscious demographic. Consumers are now more informed and selective about their food choices. While Kraft Heinz has made efforts to introduce healthier alternatives and reformulate some of its existing products, these changes have been gradual. These efforts have been met with mixed success, struggling to shake off the image of a legacy brand entrenched in outdated dietary habits. The company faces the challenge of changing public perception. The competitive landscape has also intensified, making it even more difficult for Kraft Heinz to regain its footing. The rise of smaller, nimbler food companies, often focusing on organic, natural, and locally sourced ingredients, has disrupted the market. These companies have chipped away at the market share of traditional giants like Kraft Heinz, who now find themselves in a battle to stay relevant. These smaller players are often perceived as more innovative and responsive to evolving consumer demands, quickly adapting to trends and preferences. They attract a loyal following willing to pay a premium for products aligned with their values, creating a strong customer base. Kraft Heinz's struggles are emblematic of a broader trend in the food industry, where traditional business models are being challenged. The days of relying solely on brand recognition and economies of scale are fading. Companies can no longer depend on their legacy status to drive sales. Companies need to prioritize innovation, agility, and a deep understanding of changing consumer preferences to thrive in this new landscape. Adapting to these changes is crucial for long-term success. Beyond the challenges posed by shifting consumer preferences and a more competitive landscape, Kraft Heinz has also grappled with internal inefficiencies. These inefficiencies have manifested in various ways, from operational bottlenecks to strategic missteps that have hindered the company's ability to stay agile and responsive. The 2015 merger of Kraft and Heinz, orchestrated by Warren Buffett's Berkshire Hathaway and 3G Capital, was touted as a way to unlock significant cost savings and operational synergies. The merger was expected to create a powerhouse in the food industry, leveraging the strengths of both iconic brands to dominate the market. However, the aggressive cost-cutting measures implemented by 3G Capital, while initially boosting profits, are now seen by some analysts as having come at the expense of long-term growth and innovation. These measures included significant layoffs, budget cuts, and a relentless focus on efficiency that, while beneficial in the short term, may have stifled creativity and innovation. Critics argue that the deep cuts to research and development, marketing, and brand building, while improving short-term profitability, have left Kraft Heinz ill-equipped to adapt to evolving consumer tastes and compete with more agile competitors. The reduction in R&D spending in particular has been a point of contention, as it has limited the company's ability to innovate and bring new products to market. The company's focus on cost optimization over innovation may have hampered its ability to develop new products and revitalize its existing portfolio, further contributing to its stagnant revenue growth. This strategy, while financially prudent, may have overlooked the importance of staying relevant in a fast-paced industry where consumer preferences are constantly changing. Moreover, the integration of the two massive companies, Kraft and Heinz, proved more challenging than initially anticipated. The complexities involved in merging not just operations but also corporate cultures created unforeseen hurdles that slowed down the process. The complexities of merging two distinct corporate cultures, supply chains, and distribution networks likely diverted resources and management attention away from innovation and responding to evolving consumer trends. This diversion of focus may have caused the company to miss out on key opportunities to innovate and adapt. The focus on integrating the two companies may have come at the expense of staying ahead of the curve in a rapidly changing food industry. As the market continues to evolve, the ability to quickly adapt and innovate becomes increasingly crucial for long-term success. Despite the challenges facing Kraft Heinz, one aspect of its profile continues to attract a particular segment of investors: its dividend. With a current yield of around 4%, significantly higher than the average dividend yield of the S&P 500, Kraft Heinz stands out to income-oriented investors seeking a steady stream of passive income. This attractive dividend yield is particularly appealing in the current market environment, where interest rates remain relatively low. Investors looking for stable income-generating assets may find Kraft Heinz's dividend appealing, especially given its long history of dividend payments and its status as a consumer staples giant. For investors prioritizing income over growth, Kraft Heinz's high dividend yield can provide a measure of stability and cash flow. However, it is crucial to acknowledge that a high dividend yield is not always indicative of a healthy or growing company. In Kraft Heinz's case, the high yield is partly a function of its stagnant stock price, which has struggled to gain traction in recent years. This highlights the importance of looking beyond just the dividend yield and considering the company's overall financial health and growth prospects before making any investment decisions.